Welcome to Chapter 2 of the Put Options course. Again, in this course, we are going to look at Apple options to understand put options. So we have Apple option series here all the way up to Jan 2014. We have a weekly series that expires in 5 days. We have a May series that expires in 26 days, and the June series expires in 54 days. So I'm going to look at the June series. Now, on the call options course, we looked at the left-hand side of the screen. And the put options are actually on the right-hand side of the screen. So let me change my layout. So we have a last trading price and a net change. The layout of the put options is a little complicated, and a lot of beginners might have a challenge with the way put options are structured. So I'm going to describe this layout in detail first. We saw in the call options that the at-the-money call option for Apple was the 570 because Apple's current trading price was 572. And then the out-of-the-money that we looked at was the 625 call, which was shaded in black. And then the in the money that we looked at was the 520, which was going for about $69, and that was in the money. So in the money options on the call side are shaded in gray, and they are on the top left. The out of the money options on the call side are shaded in black, and they are on the bottom left. The layout of the put options is exactly the reverse, because call options, the strike prices increase like this, and you're looking at out of the money options on the lower part of the screen. On the put options, it's going to be reversed. The at the money options are not going to change. On the put option side as well, we have the 570, which can be considered at the money, or the 575, which can be considered at the money. The 575 put option is technically going to be in the money. So here we saw that the call option, the 570 call, was slightly in the money. It was in the money by $3. And here the 575 is going to be in the money, and it'll be in the money exactly by $2. So we'll see all that. Now, on the put option side, we have in the money options that are again shaded in gray, but they are on the bottom right side of the screen. And we have out of the money put options that are shaded in black. So let's try to understand this. The 625 put is in the money because Apple's current trading price is already below this put option. So when you buy a put option, you are looking at the price of the stock going down. So let's say if we bought, for example, the 520 put option. The 520 put option is out of the money because Apple has to go from 572 all the way down to 520 for this put option to become profitable. So this is very similar to our 625 call option, which was out of the money. In the case of the call option, Apple had to go from 572 all the way to 625 before this call option would become profitable. In the case of the put option, Apple has to go from 572 again all the way down to 520 before this put option can become profitable. So the 520 put option is actually out of the money in our case. And on the call side, the 520 call will be in the money. Similarly, you have the 625 put option, which will be in the money, and on the call side, we have the 520 call would be in the money. So you can see it's exactly the reverse. The layout is reversed, and the gray shaded areas are also reversed. That tells you that in the money options will always be shaded in gray. Of course, you can customize your platform for different colors and things like that. But here you can see that the gray represents in the money options, and then the black represents out of the money options. So another challenge that newcomers generally have with put options is understanding what an in the money put option is. So here we have the 625 put option being in the money. So what exactly does this mean? Apple is currently trading for $573. So if you buy the 625 put option, you're going to pay a lot more premium because this is said to be in the money. But what exactly are you telling the seller of this put option? You're telling the seller that you want the right to sell Apple at the price of 625. Okay? So in the case of a call, you were telling the seller of the call option that you wanted to get the right of buying the stock at 520 when Apple was already at 573. So what he did was he just added the intrinsic value to the value of the option. So similarly, on the put side, you're telling the seller that you want the right to sell Apple at 625. Now, why would he give you the right to sell Apple at 625 when the price is at 573? Well, it's very simple. All he's going to do is add the intrinsic value of this option to the value of the option, and that's why you're paying much more for this in the money put option. So if we come back and look at the same kind of layout that we looked at the call options, let's look at the intrinsic and extrinsic values. We'll see that this put option has an intrinsic value of almost $52 and an extrinsic value of $17. And it should again be clear that anything below the stock price of 573 is going to have no intrinsic value. So you'll see all the intrinsic values are zero for any strike price that's below Apple's stock price. So again, the layout is exactly the opposite. Intrinsic values will be zero because these options are out of the money, and all intrinsic values of any options that are above Apple's stock price will be in the money. And similarly, just like we saw in call options, your intrinsic value is going to increase as you go deeper in the money. So here we went deeper in the money this way. We went on the screen, we went up like that. And here we go down on the put side. So the 635 put option is going to be deeper in the money than the 625 put option, and the 625 put option is going to be deeper in the money than the 600 put option. And finally, we'll come to the at the money put options that are closest to the stock price, which is the 570 put and the 575 put. So that's how the layout is structured on the put side. So mentally, if you're new to options, if you're new to such a screen, you'll have to get adjusted to this layout. It's very important that you understand this layout and get adjusted to it. It's not very complicated, but if you're looking at it for the first time, it will seem complicated, but the more you look at it, you'll understand the layout. So now we're going to consider three different options, just like we did in the call options course. We have an at the money put option, which is the 575 strike price. This at the money is actually technically in the money by almost $2. And you can see that the price of the stock is 573. Therefore, the 575 strike price will be in the money by about $2 because Apple has already gone down below this strike price by $2. So the first option that's in the money is going to be the 575 strike price. And then we have the 625, which is deep in the money. It has an intrinsic value of 51, 52 almost, and 17 extrinsic value. And the 520 put option is going to have zero intrinsic value because it's deep out of the money, but it has an extrinsic value of $15. So these are the three options that we are going to model, and I'll show you the P&L diagrams of these three options. But let's just start with the first one, which is the 575. So if you wanted to buy this put option, you would pay an amount of $35.85. So I'm going to click on that and change my number of contracts to 1. So this is what a put option would look like. It's a single option. We are buying a put option. We are buying one contract of Apple, the June 2012 series, at the 575 strike price, and it's a put option as opposed to a call option. And we are going to pay $38.05 per share. So for 100 shares, we'll be paying $3,805. And that's exactly what your buying power also shows right here. And because you're a buyer of a put option, that's exactly what the margin that's going to be held by your broker. We'll see that when you're selling this put option, this margin is going to increase, just like we saw in the call option. Because once you're a seller of options, your risk profile increases. So your broker is going to hold a much larger amount when you sell options. So this is our put option, and the way we analyze this is we go to the risk profile, and that's exactly what the risk profile of a put buyer looks like. The put buyer will profit if the value of Apple goes down, and if the value of Apple goes up, then he's exposed to losses, but the losses are limited because he's a buyer. And if you see the red line, that is our expiry line. The white line is our line today, and the bottom left numbers tells you that if Apple goes up, then your maximum loss is $3,805, which is derived from 100 shares at 38.05 per share. So that's your maximum loss. Anything, if Apple goes anywhere above 575, which is your strike price, you can see the red line changing directions there. If Apple is above 575 on the day of expiry, then you're going to see a maximum loss of 3,805. On the other hand, if Apple goes down, because that's what your expectation is when you buy a put option. When you buy a put option, you're bearish on the stock. So if Apple goes down, you'll see that the white line starts to accumulate profits right away. But for the expiry line to work, you have to subtract the premium to get your break even. So the break even now is on this side of your strike price. That's because this is a put option, and this is your strike price of 575, and the premium you paid is 38.05. So your break even is going to be 570 minus 38.05, and so that works out to about 536 or 537. So that's exactly where your break even point is, where it crosses the zero line, and anything below 537 is going to be profit for you on the day of expiry. However, once you get into this position, if your Apple starts going down, and I need to reset my parameters. Yeah, so you'll enter your position here, and if Apple goes down, you'll see that you can accumulate profits right away. So if tomorrow or on Monday, if Apple goes down by $20, you'll have a profit of $1,100 on this position. On the other hand, if on Monday it goes up by about $20, you'll be losing about $900 on this position. So that's how the at the money put option works for a buyer. So now let's look at our out of the money put option. So in our case, the out of the money put option is going to be the 520 put. And you'll immediately see that now the red line changes direction at the 520 strike price. So you pay much less for this option. You're paying only $15.75. So your max loss is going to be if Apple expires above 525. And that max loss is capped to $15.75. And that's exactly what your buying power also shows. For you to be profitable, Apple must go below this amount, which is 504. So how do we get that? It's because our strike price is at 520 and we paid $15.75, so we need to minus that, and that's exactly what we see over here. So our break even here is 504. So again, if you think back to the call options, the price of Apple needed to move up by quite a bit for the out of the money options to be profitable. Similarly, the price of Apple must move down by quite a bit. It has to come down from 573 all the way to 504 for your put option to be profitable on the day of expiry. However, I'll repeat, we don't have to wait till expiry. As long as Apple moves in the direction that you are expecting it to move, you will see profits on your position, and you can close it at any time when you feel that you've hit your profit target, or if you feel Apple is now going to change direction and start going up. In that case, you can close your position as well. So that's the out of the money put option. Now let's look at the in the money put option, and in our case now the in the money put option that going to look at is the 625. So immediately you'll see that the red line changes direction at 625. That's our strike price, and our break even in this case is going to be the strike price, which is 625. And in this case we are paying a lot more for this option because this option has intrinsic value. It's an in the money option. It's got a lot of intrinsic value. So about $70. So if you subtract 70 from 625, that's exactly where your break even is. So your in the money put options are going to have a much better chance of profitability and much quicker. So your in the money options are going to have a much better probability of success because all Apple has to do is move from 573 down to about 555 for you to start breaking even on this option on the day of expiry. However, if Apple starts to go down immediately, and even if it goes down by about $10 to $12, you'll see that you have a profit of about $850. Similarly, on the downside, also, if Apple starts moving, on the upside, if Apple starts moving up, you'll see that you're going to accumulate losses on this particular option. So the in the money has the best shot at success, but it's going to be much more expensive. The at the money has a 50-50 shot, and its price is going to be less than in the money, but more than an out of the money option. So this is how we look at profit and loss diagrams from the view of a put buyer. All three options have different prices, they have different probabilities, and they have different profit and loss graphs. Selecting which option to buy, which option to sell is obviously going to be the important criterion, and we'll be focusing on that all through the course. So this is as far as the buyer's perspective is concerned. Now let's look at this from a seller's perspective, and let's start with our at the money put option that we saw. This is at the money, and if we were a put buyer, this is what our profit and loss graph looks like. But if you were a put seller, then this graph will be exactly reversed on the x-axis. So where you have limited losses, you will have limited profits on this side, and where the buyer has unlimited profits, the seller is going to have unlimited losses this way. So all we need to do to look at it from a seller's standpoint is change this buy to a sell, and you'll see that the graph exactly gets reversed around the x-axis. And when you look at a put and a call option, you'll see that the graph gets reversed. It's a mirror image on its y-axis. So all we need to do is change this put to a call, and you'll see the profit and loss profile for a call seller. So the call seller will have exactly the opposite. So he'll have limited profits and unlimited losses on the upside if the stock goes up. And if for a put option, it is exactly the opposite. So it's reversed around the y-axis when you look at the differences between a call and a put option. And when you look at it from the perspective of a buyer and seller, the graph gets reversed on the x-axis. So that's what that looks like. So those are the four different types of profit and loss profiles that are important. These are all single option strategies. So this is important, and don't worry too much about the fact that a seller of a put option has unlimited losses on this side. There are ways to mitigate that by the use of spreads. But again, when you look at the margin held for a seller, it's going to be much more than the buyer. because it has an unlimited risk profile. Therefore, the seller is going to be held for much larger margin amount. And if Apple were to go down by 10%, now we are looking at these simulation lines. If Apple were to go down 10%, that would be this dotted line. Now your losses are going to increase. You would have already accumulated a loss of $3,465, and now your margin requirement is also going to go up. So your margin requirement's gone up to almost $14,000. So that's how these profit and loss graphs work. Let me quickly show you what happens when you put a spread and limit your losses, okay? But I just want to give you a quick preview of how you can limit this loss so that you understand that aspect right now. So here we are selling a put at 575. So what we are saying is, as long as Apple stays above 575, then the seller of this option will get to keep the maximum profit. The maximum profit is capped, and it's capped at 3,745 because that's what we are paying, $37.45 per share. But let's say we wanted to cap the losses on this side. So we sold the 575 put. That's what we are selling right here, okay? So that is this strike price right here. Let's say we wanted to limit our risk at 550, okay? So by selling the 575, we received a premium of $37.45. So to limit our risk at 550, what we need to do is buy this put option at 550. So let's go ahead and simulate that. So on the put option side, we come to the 550 put. And so remember, we've sold this option. We've sold this option at $37.45, which is the bid price. And now on what we want to do to limit our risk is to buy the 550. So again, let me change this to one contract. And so what we have done is we've sold the 575 put option and we received $37.45. And now we are buying the 550 put, which is this one, to limit our risk. And so for that, since we are buying it, now we have to pay the premium for this put option. So basically what you're doing is then you're collecting the difference between these two option prices. So it'll be 37.45 minus 26. It'll be about $11 or so. So now if you look at your risk profile, your risk is capped on the downside. So you still have a profit potential. Now your profit potential has also reduced because you've paid for this option. You've paid for the 550 put option. So your max profit now becomes 1,130 on this particular spread. But then look what happens to your margin. Your margin also gets much reduced. So all you have to look for from your broker is to hold about a margin of 1370. That's because now you have limited your risk at this strike price. You've limited your risk at 550. So we can see that the red line changes direction in two places because now we have two options and the strike prices are, the first strike price is 575 and the second strike price is 550. Now you've limited your risk because if Apple starts to fall and let's say it goes to 500 right here, right? So this option that you sold is going to be seriously in losses. But this option that you bought at 550 is going to be seriously in profit. Because when you buy a put option, you want to, your expectation is bearish. So the 550 put option is going to increase in value and the 575 obviously will be at loss, but the 550 will be at a profit. And basically the broker will match up those profits and losses and your risk is now limited to a maximum risk of 1370. So this is how you can protect the downside. So you don't need to be alarmed by the fact that selling a put option or selling a call option has unlimited risk on one side. You can always protect it. And you can always sell these options also as a spread itself. So let me quickly show you that. I can come here and say I want to sell a spread, a vertical. It's called a vertical spread, and I'll explain all of that when we get to the spread section. So I can sell it as a spread. Let me remove the first single options. I can sell a spread. So I want to sell the 575 and I want to buy the 550. So I change that, and what I get is the $11.90 credit, which is what we expect. So I can sell one contract of each. And now if we look at our risk profile, it's exactly the same. So you can sell options as a spread itself, so that you don't have to worry about buying one and selling one in two different transactions. You can do it at one shot, and that's how you limit your risk. So this is as far as the 575 put option is concerned. Now let's quickly look at the 520 option. Let's say if we were selling this put option, and here we are going to receive a credit of $15.10. It's much less than the credit here, but what does it do to your probability? Now Apple has to move from 573 all the way down to 520 and below that by this amount for your counterparty to make money on this deal. So we'll see that. Let's see that on the risk profile. So this is where Apple is right now, and you sold the 520 put. So again, this is the advantage of selling out of the money options. This 520 put is out of the money, and you can see that the seller of this option has all this room to be wrong. So this is his room for error. On the call side, you saw that the room for error was on this side. On the put side, it's obviously on the other side, because this is a mirror image on the y-axis. So even if Apple goes down, but it does not come close to 520, the seller of this option will still make his full profit. And even beyond 520, he would have received a premium of $15 for each share. So 520 minus 15 is his break even. So really, Apple has to fall below 505 for this put option to make a loss on the day of expiry. Obviously, if you look at the white line, then he's making losses temporarily. But if you hold on, and if you think Apple's not going to hit these levels, then you can hold on to these options. So your account may show a paper loss at this time, but as you approach expiry, this white line is going to collapse onto the red line, and this time the collapse is going to happen this way because you're selling a put option. So it'll collapse onto the red line, and you will make your profit. So you have a lot of room here for the seller, and this is the advantage of selling out of the money put options. So that's what we are looking at here. We are looking at an out of the money put option, and let's quickly look at an in the money put option and from a seller's perspective. I need to choose the 625 put option, and you'll see that Apple is already here, and anything below the break-even price, which will be calculated 625 strike price minus this premium. You're receiving a big premium, but your room for error is only this little triangle here. So your triangle is this. This is your only room for error. So if Apple starts to go down, your break-even gets hit very quickly, and your losses can accumulate. So in general, you shouldn't be thinking of selling an in-the-money option at all, because first of all, your room for error is very little. Don't be attracted by this premium amount. Whenever you're looking at options, you always have to think from a probabilistic mindset. That is much more important than the premium. So you should never be thinking of selling an in-the-money option. And in fact, even close to at the money, you should never be thinking. You want to put probability on your side if you're a seller of options. So in that case, what you would really sell is out of the money put options somewhere here, the 520, 510, 530, somewhere in this range, and put probability on your side to begin your trade itself. Okay? So that's very important. When you're selling options, make sure you're going to go out of the money. There might be some situations where you want to get closer to the money, but we'll look at all of that. I'll highlight those as we run into that. But this is what the seller's profile would look like, and selling an out of the money option is the most viable strategy. Selling an in the money option is not a good idea at all, because your losses can accumulate really quickly and you're also exposed to unlimited losses. Now, you could do one thing. You could, since you sold the 625, you could try to protect it at some point by buying a spread here, say perhaps at the 560 or 550, but you'll be paying a lot for those options also, so your credit is going to be less. But those are all details that I want to get into when we go into spreads. But in general, I would suggest that you look at putting probability on your side when you're a seller of options. Now, when you're a buyer of options, it's a very viable strategy to go in the money, because first of all, your losses are capped as a buyer, and secondly, if you get the movement you're looking for, that movement is going to be fairly quick. And thirdly, this is a point I've touched upon earlier, an in the money option has less extrinsic value, so it'll suffer less time decay. But again, that's a different course. We're going to get there. So these are the two perspectives, the buyer and the seller perspectives. And I think we have reached the end of this chapter. So what I want to do in the next chapter on the put options itself, I just want to recap the 4 different positions. So we have a call option and we have a put option. So these are the 2 types of options, but in each of these options we have a buyer and a seller. So we have 4 different options, and conceptually how you can think of when you think of these 4 different options. And this is again a challenging part for newcomers, so I want to take some time and explain these 4 different positions before we start moving on into some very interesting concepts like time decay and implied volatility and Greeks in this module itself. All right, so I will see you in that chapter 3. Thank you.